Good morning and welcome to the Short Vol Show. My name is Dave, and I just talked for like 10 minutes without pressing the start button. So, a whole lot of people got to hear me talk. Actually, nobody got to hear me talk. So, let's try that again. Welcome to the day. I know that viewers of the show probably at some point today, if you go on to any sort of chat room that has to do with volatility, you're going to see some comment that says, wow, what a scam. Um, people bought UVXY or they bought VXX, and we've had a couple days of volatility, and yet these things really are moving nowhere. VIX up a point, VXX up 20 cents, UVXY up 30 cents with the VIX up a point. Wow, what a scam. Well, what's really going on here? Well, what's going on is that you can go onto those forums and you can tell people, no, it's not a scam. No, it's not manipulation. Something really is happening here, and it's happening instead of volatility is getting translated not into necessarily much higher VXX and UVXY prices, but rather into the deterioration of the shape of the term structure. So let's go look at the term structure, and I'll tell you what I'm talking about. And for this, I want you to imagine the analogy of a car driving down the road and hitting a speed bump. And we're going to use parts of the term structure as parts of the car here. So let me get out of the way. Now, you can think of the spot price, this bottom line here, 1501. You can think of that as the wheels of the car. You can think of the top of this chart up here as sort of the top of the wheel wells of the car. And you can think of these two futures, which is what these VIX products are based on, as the shock absorbers. Now, as the VIX went up a point from 14 to 15, and let me get my pen out so I can illustrate this for you. Instead of actually these products moving up a lot, these products moved up a little bit, but instead of them moving up more, what happened is that this spot moved up towards the futures, and the futures just kind of stay where they were. And so this distance between the spot and the futures that we call the roll yield has decreased remarkably. Right now we can see if we subtract spot price from the front month future price, we can see that there's 47 cents in the roll yield right now. That is reduced from about $1.50 on Friday. So where is this VIX volatility going? Every time you see the VIX up, that volatility, that move is going somewhere, and in this case, it's mostly going into the term structure flattening out. So when we look at the contango number at the bottom of the screen, we see that that's down to 8.85%. That was up around 14 2 trading days ago. And on Friday, it got down to 10.11. Now it's down to 8.85. That means that this line between these two front futures has flattened out. It was steeper, more like that, and now it's flattened out. If the spot moves higher, it'll flatten out even more. So this isn't a scam. It's not manipulation. This is the term structure flattening out as we get a move up. Now, you'll notice there's not that much room anymore between the spot price and the front month future. There's only 47 cents. And once we run out of room there, we've run out of room. Either we have to go into a situation where we're inverted, or these products have to move up. And in reality, what happens is a little bit of both. But when we look at the term structure here and we see there's not that much space between the futures and the spot, we know that it's kind of like a car with a shock absorber, which is compressed. If we get continued volatility, the next only thing that can happen is these VXX products move higher, because there's just not a lot of leeway. We've already used our shock absorber over the last couple days, and that is off the table. And now continued volatility is going to push these products higher, and you're not going to see such a poor performance by them. But know to yourself that when you see the VIX up and you don't see much movement in these products, that means it's probably getting absorbed somehow in the term structure. And you do hear people saying, oh, that's a scam. You hear long saying, oh, that's a scam. These products are manipulated when we get a rise in volatility. But know that this happens on the downside too. When and if we get a little bit of a rally in the markets and volatility comes off, as this whole process reverses and the spot price moves back down lower again, these futures, the relationship is going to extend. And besides that, and more importantly, this spot price is going to move way lower without the futures moving down all that much, as it's like the opposite. It's like the shock absorber is extending again, and you're not going to get as much of a down move as you might have thought in VXX and whatnot, because it's, once again, the term structure is normalizing, and that is sort of absorbing the move. So in the end, what you get is just sort of a dampened move in VXX. So you might look at your screen and you see, oh, VXX 15.5, VXX 15.5, with VIX moving all over the place, and VXX not moving that much. It's because the term structure is kind of absorbing both to the upside and to the downside on these moves. Let me ask you a question. What's the first thing you do when you come into the trading day? Do you check your watch list, look at what's happened overnight? I was taught that every trading day, when you come into the day, you should ask yourself, what is the theme today? And you should be able to find a theme every day. Now, some days the theme is going to be the president's tweet. The president tweeted about this or that. It might be looking at Drudge Report and seeing Ricky Gervais trashed Hollywood. I don't know why that's so important, but it might be some celebrity news. But what you should be doing is figuring out what the theme is today, what's going on. And a lot of times what I do is I'll be checking the futures overnight, because I'm a crazy trader and I'm always checking the futures. On a Sunday night, we know that the market reopens 6:30 at night, depending on your time zone. 6, 7 at night, the futures reopen. And so I was watching last night and I saw the futures down. And so then I was following that. I woke up at 3 in the morning to check and see where the futures were. And then I woke up at 4 because, as we know, 4 in the morning is when VXX and these products start actually trading. And you can see what the VIX is doing. You can pretty much see what VIX futures are doing the whole time, but you don't actually get to see these products start trading until 4 in the morning. But I woke up then, and let's pull up a chart of the E-minis to see what the theme is today. And it's very clear when you do that what the theme is. And to me, the theme today is the market appears to be rallying back from where it was. We were down 21 points right on the open in the E-minis, and now we're only down 8 points. So the theme is sort of, are we going to rally back all the way today to unchanged and above? Is the rally going to hold? Is the sell-off going to hold? Actually, we are still, negative on the day right now. So is that going to fade back farther negative today, or are we going to rally? We're kind of in a flat situation. If we pull up the 5-day chart, we're pretty sideways. I mean, you could say for the year, since it's only been a couple of days in the year, but pretty sideways right now. That doesn't look like a huge rally going on. There hasn't been a huge rally this year, if you count this as the new year. So, and we know that the term structure has deteriorated. Now, this makes me unhappy because I have a long-term position on. So for me, I'd rather have VXX right now be up around 1650 and have the term structure be still in 14% contango than have it that, VXX is only up 14 cents, but term structure contango has become less, because long term, what's going to pay my bills is us staying in a higher contango. Now, I can't control that. We're spoiled in the last couple of months. If you've started trading the VIX, I know some of you are kind of new to this stuff. If you've been only into this for the last 6 months, you're very spoiled because, we've had just these down every day, the market slowly rallying and down on this stuff, and action can start happening at any time. So don't be surprised if we start getting some action, because things have been very calm for a long time. And, we've gotten a couple days of a little bit of volatility, but nothing compared with like an actual real sell-off. Just very mild. Everything's very mild. Let's go take a look at realized volatility. I'll go to SPX here. At historical volatility for the last few days and see, I know it's upticked, but let's just see how much it's upticked. All right, so the bottom of the screen is going to show historical volatility, and we can back this out to, let's go to like 30 days maybe. That's kind of still too short, but... And you see, even with 30 days here, you can see that these numbers are moving up. It was up to, 12% on Friday, 11%, 12 up here, which is more reasonable. With the VIX all the way up around 15, when we're having a 7% volatility realized, that means that people who own the VIX it's not gonna work out for them. And people that own puts and calls in the SPX, unless they are exactly right on direction, that's not going to work out either. So everybody who's gotten kind of a little nervous and bought in volatility around up here, unless we actually continue to move and actually move more than we have in the last couple days, the movement we've had in the last couple days makes it almost just sort of fair value owning volatility here. We need more than this for it to be successful for people being long options and stuff. And as far as being long VXX or UVXY, we need a lot more for people to actually make money being long these things. So we might get it. I mean, the trend is increasing right now. We see realized volatility increasing the last couple of days. If things continue to increase in volatility, then we might see a higher VIX. And it wouldn't be out of the realm of possibility that something bigger happens as far as market moves. We've seen a disturbance in the force, so to speak, when we look at volatility in the last couple days, and things could move higher from there. I do want, if you take one thing away from this, though, today, I want it to be that when we see an up move in the VIX, if we've had several days of just a rally in the market and the term structure is extended, when we start getting volatile days, we've had 1 or 2 or 3 days of a little bit of volatility injected, it slowly deteriorates the amount of contango in the term structure, and it slowly flattens out the term structure. Now, if we got a big move in one day, this process would be accelerated. But when we look at the term structure, when I look at the term structure today, what I see is that the term structure has flattened out, that the space between the spot and the front month future has flattened out. It's only 58 cents right now between spot and the front month future, the roll yield, so to speak. Contango has flattened out, and the health of this term structure has deteriorated. So regardless of the fact that VXX and UVXY haven't moved all that much, the situation has deteriorated somewhat, and it's something that I'm keeping an eye on, definitely. Some people use the VVIX as an indicator, and if we were to do that, the VVIX really not doing a whole lot, 94.31, but up 52 cents. So if you're going to use that as an indicator, it's not indicating anything really on the horizon here. And the market seems to have rallied back from a pretty big deficit. you might say to yourself that, well, the VIX up 85 cents, the market's only down 650. That seems like the VIX is staying elevated. And I could see that. It's kind of hard to tell, though, because, we have had the move down. I would suggest to you that if the markets just kind of stay in this area, plus or minus 10 points in the E-minis, that VIX number is going to creep lower. Because once again, when you have an elevated VIX, that means people have bought options in the SPX, and they don't want to hold on to that hot potato for too long if nothing's going on. And it seems like nothing's going on all of a sudden again. If we just kind of move sideways to slowly rally from here the rest of the week, you're going to see that this stuff start to deteriorate. You're going to see the VIX start to move lower. You're going to see this term structure start to extend again. And that's, for me, being short volatility. I'm short VXX. What I want to see is the term structure to extend again. I want maximum contango at all times. Now let's take a look quickly at the position just to refresh your memory. The position we have on right now is we are along the 21 Jan. When I say 21 Jan, I mean that it's Jan options expiring in 2021. They actually expire on the 15th of Jan 2021. We are along 200 and something of the Jan 7 puts and a couple of the Jan 8 puts. And what's happened with those? Well, I watched them very carefully. Ooh, it looks like 199 of those Jan 7 puts just traded. Let's take a look at time and sales and see what happened with those. So if you look at the screen to the right of me, you can see the Jan 7 puts are kind of right at the level of my glasses almost. And you can see 199 of them traded. I have my pointer on there now. So if we go to time and sales, and I can do that just by closing that options chain, clicking on time and sales, and then selecting just the Jan options for that one series. All right, so we've had a buyer of these Jan 7 puts, which, when you own something, you like seeing people coming in and buying them because that means that market makers are selling them and maybe they're going to raise volatility. As a market maker, we don't want to sell stuff forever. So at some point, when we've got a lot of buyers, we're going to raise volatility. And that means that the ones that I own will be more valuable, which is a good thing. Just to look quickly at a shorthand to see what volatility in general this month is trading at, we can look over on the screen to the right side, once again to the right of my head here, and you can see that Jan volatility. It shows 76. That's just a rough estimate of volatility. We know that each option has a different volatility, and this stuff's in a skew where out-of-the-money calls have a higher volatility than at-the-money. Just to illustrate the skew here, while we're on the topic, let me get out of the way for this too. I can go over, and at the top of my screen here, and I think it's off the screen, so let me move this. All right, at the top of this chart here, you can see it says volatility open interest here under layout. If I click this, there are several default layouts in the screen, and there's also custom layouts, which I've set up myself. Now, the custom ones I use when I'm trading, they're going to give the size of the bid and the size of the offer and things that I need for trading right now. But I often look at these different screens, and let's go to implied volatility. Now, this isn't always 100% accurate, but it's going to give us a rough idea. And as we look on the left side of the screen here at the calls, the farthest left column is going to show implied volatility for the calls. And you're going to see as we move up in strikes, the volatility goes higher. So at the money is 76. Once we get up to the 30 calls, it's 84. We get to the 50 calls, it's 88. So that's a skew to the upside. And the reason that's there is that if a VIX product is going to make a big move, it's going to be to the upside. It's the opposite of an index, a stock index. A stock index, people aren't worrying about, whoa, this index could double tomorrow. But people are always worried about a crash. And so the violent move, if there's going to be one, is to the upside in a VIX product, because that VIX product spike when something bad happens. So That's why there's a skew to the upside. Skews came about after the 87 crash. I get that confused because I hadn't started trading then yet. After that period, they introduced skews into options, and we have the opposite skew in VIX options. All right, well, I'm going to keep this short and sweet now because people get mad at me for I've already gone 38 minutes, which is a long time, and I'll let you get back to your day. Thanks for watching. Best of luck to everybody, and I hope you are profitable this week, and we will continue to watch closely the term structure. Thanks for watching again. See you soon.